Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Happy New Year. It's really the first trading day of 2015 as far as I'm concerned. I don't count last Friday, but welcome to 2015. It should be a wild and prosperous year as far as I am concerned. All right, let's get into the charts and see what we've got in front of us. So the market started out with a bang on, I'm sorry, I forgot to give you the date. I always give you the date. Monday, January 5, 2015. All right, so market started out with a bang on this Monday with a nice, healthy down day. The S&P was down over 37 points, down over 330. NASDAQ down almost 75. Basically, it was a 1 3/4, 1.5%, 1.86% type of down day, depending on which market you're looking at. Transports were down over 2.5%. So it was just a big thrashing all the way around on the first day of the year. And, this is the reason why I kind of stopped trading, with exception of one or two swing trades, right when we got to about the Christmas period. So middle of December, if you remember, we hit the bottom. We kind of called the bottom. And then we went up from there, and we hit a top over here on the 29th. I think this is the 29th, right? And then basically the market's been selling off ever since. And I said the last couple of videos that I did do in December in 2014, I said we're going to look for the January pivot point in order for the market to kind of get its footing, and it's going to tell us the story of where we go forward from there. So we're not there yet, and we're going to let the market fall a little bit, and we're going to find out where the pivot point's going to be. So here, basically, I have three, in my book, I have three opportunities for a January pivot point, and I'm going to give them to you here. So the first one is going to be right at this 199 to 199.5 area. You see all this chart support here? Even though we've already come into this chart support once, this is in December, that doesn't mean that this still isn't important support. Even though we went through it, okay, this is still a lot of chart support. When you spend a few weeks chopping around in this area here from, let's say, the 25th of August, until the 19th of September. So a solid 3 weeks chopping around in this neighborhood, okay, it's still going to provide a level of support. And where that level of support is, we'll overshoot a little bit, and we'll say come down to this lower level of it, and we'll say 199 to 199.5. That's going to be still good chart support. But if we don't hold that, okay, and we don't hold this double bottom, then your next level that's important to me would be the 200 period moving average, and that'll creep up between now and the next several days, okay? And if we don't by chance hold the 200 period moving average, then we're going to look for this gap window here down at 191.5. In fact, the exact number is 191.48. Okay, so your three numbers, 191.48, wherever the 200 period moving average is at the time, and let's say 199 to 199.5, roughly in this neighborhood here, okay? All this chart support here. So that's where we're expecting those three levels, okay? This is the near term, this would be the second target, and then this would be the January bottom if we really had a thrashing in January. And if you go back, so now's a good opportunity to talk about two reasons why this may be A, a volatile year, and B, however, a positive year, because A, you have that old adage about the third year of a presidential cycle, and I don't believe in a lot of that stuff, but when the numbers work, and the third year of a presidential cycle does come out more often than on a higher percentage, certainly a lot higher than 50%. I like to use things that give me at least 75+%, and I think this one's in there. I don't have the exact numbers in front of me, but I'm pretty sure that the third year of a presidential cycle is normally a positive year the majority of the time. But that's not a reason to buy the market. It's just something to be aware of. The second item is, and this is the neat one, okay? And I don't know how far back this goes, but I know if I go back over 100 years, okay, even into the 1800s, okay, the late 1800s, the fifth year of a decennial cycle, so 1895, 1905, 1915, and so on, all the way up to 2005, and then 2015, which is this year, obviously. I think there's only been one down year of the fifth year of a decennial cycle. So that's something to be aware of. When you see that many up years in the same year, the fifth year of every 10-year period of time, okay, or just say years ending in 5, when there's one down year in over 100 years, let's say 100 years would be 10, and I know that I went back at least 13, so say 12 out of 13 was up. And I think that's important then. So that gives me better than a 90% hit rate on that, obviously. So I'm going to say that that's important. So that's really more on the cyclical work, cycle work, but nevertheless, it's important. So I thought I'd bring it up. And those two items are important this year. And that's why, along with some calculations, I come up with a absolute bottom, meaning if we went through the first low and the second low, I don't think we'll get past this 191 and a half level in January, and then we could look for a rally probably for a good 6 weeks following that. But we're not there yet. We'll know it when we get there. But that's something I wanted to bring to your attention, and that's why I spent a lot of time on it today. Okay, so let's move on to let's jump into gold real quick, because gold had an interesting day. It was up overnight. It was down overnight, or it was down when I woke up this morning, and then it was down earlier in the day a little bit, and then it was up at the end of the day. And if we just look at an intraday of the GLD, okay, you'll see what happened. Okay, we went up, then we went down again, and we followed this pattern several times over the last couple of days. Okay, and what happens is we went up and down and then up. As the market got weaker and weaker, gold got stronger and stronger, and basically the dollar yen got less and less strong, or weaker and weaker. So that was a big part of it. I know I don't talk about the dollar yen a lot, and I'm going to start talking about that a little bit. One of the subscribers brought that to my attention the other day, and it's not for the lack of looking at it. I always look at the dollar yen, but I figured if other folks are looking at it, we can start talking about it. It's not something they discuss on CNBC or in any of the financial publications all that much, but it's basically this. You have three central banks, and I talk about the Bank of Japan, the U.S. Central Bank, and the ECB. Well, when Ben Bernanke was the chair of the Federal Reserve here in the U.S., basically he decided, along with the Bank of Japan and the ECB, Mario Draghi and his predecessor before that, that it was important that, since we have a global economy, it's important that the central banks act in concert with each other. And if you remember during the financial crisis, they would act in concert together in adding liquidity to the global system. Well, what happened was, if you go back to the point in time in which the dollar would sell off and gold would go higher and the stock market would go higher each and every day that the dollar was lower, and vice versa, but that's not been happening. In fact, the market's been going up as the dollar's been getting stronger. But if you overlay a dollar-yen chart against the stock market, you'll find out that as the dollar yen gets weaker, the stock market gets weaker. As the dollar yen gets stronger, the stock market gets stronger. And that's basically what you call the yen carry trade. So they're selling yen, and when I say they, it's all the big institutions. They're selling yen and they're buying the market, whether they're buying Japan, the U.S. market, the European market, what have you. They're selling the yen, they're buying the market, and that's basically been the trade on for a couple of years now, or maybe even a little bit more than that. And so I'm going to start talking a little bit more about that from time to time, but I thought I'd bring that to your attention. And one of the members that, or the subscribers that mentioned it to me, you know who you are. Thanks for bringing it up. So it reminded me to begin talking about it, and that's a good area for everybody to get familiar with. Okay, so let's move on from there. So gold, what do we have? Let's go back to the daily chart. I'll kind of give you my target for gold. And here's the deal. Okay, so I did some calculations and some cycle work in gold, and what I found is this. If we get a weekly close this week above, let's say, 1180 in the price of spot gold, which right now we're at 1203, but we were down in the 1170s last night. I think 1177 or something like that. So it's not that far off. And I told you, as I've been telling you, gold is volatile, right? It moves now, $15, $20, $25 a day sometimes. So it's not out of the ordinary for us to find ourselves at 1175 and 1200 in the same day. So if we get a weekly close above 1180, then I think 1240 is in the cards. Within 1240 to 1245 is in the cards for the month of January. So this week could determine how high gold goes in the month of January. So I'm going to be watching that closely. If you want to scale it down to the micro level, a daily close above 1200 each and every day this week, okay, you got to have daily closes above 1200 this week, is going to mean the same thing, okay? So you're watching on a short term, you're watching the daily closes above 1200, but on Friday, at the end of the day Friday, as long as we're above 1179, okay, look for 1240 to 1246 within the month of January. So that could be a lucrative trade. And what that means is, from where we are now, that's about $4 in the price of GLD. So 115.60 or 115.60. So you can add $4 to that. So 119.60, 120, 119, in that neighborhood, right? It's nothing's exact. What does that give us? Well, ironically enough, 119 is this pivot high here. So you're probably going to find some chart resistance at this pivot high from early December on the 9th. So all that kind of comes together. Now I didn't get that number by looking at this pivot. I got the number by calculating using other methods, and then when it matches up with this number, it starts to make sense. So if we get up to here about 119, you're going to start looking for resistance in the chart, and if you're long gold, you either may want to take a break for a little while or watch for a pattern at that point in time, and I'll obviously be talking about it when we get there. All right, let's go to crude oil. And, I'm going to bring up the chart of the USO, but there's really little to talk about with oil because not much has changed, right? Still weak. We still haven't found the bottom. We still haven't found the high volume reversal day. Nothing's changed. Now we cracked the $50 level today by a little bit. And, when I was telling you the last couple of weeks of December was that, I said 50 was in the cards as long as we broke 53.60, but I said 48 was going to happen. So we'll see what happens. Now we were a little below 50 today. Where I'm looking at the March oil contract right now, and it's $50.65. But I think 48's in the cards, and if we break 48, then we're going to look for 45. And if we break 45, we'll probably look for maybe even 40, but probably stop at about 42.5 or 43 at that point in time. Once we get below 50, I'm going to kind of stop looking at the $5 increments, and I'm going to go down to about $2.50 increments. That's a whole nother story. I'm not going to explain that now. But so $50, 48, and then 45, 47.50, 48, 45, 42.50 to 43. That's kind of where I'm going with it. And of course, I'm going to give you updates each and every day I do the videos and keep you abreast of where we are as you're seeing it trade anyway. But until we see a definitive, reversal day, there's really nothing to do on the long side of oil because all the oil stocks are going to remain under pressure with the price of oil remaining under pressure. And until we see that high volume reversal day, there's almost nothing we can do. We talked about the XLE before, and I'll just talk about that real quick. We talked about the XLE, and we had a good trade in the XLE, but look what happened here. We went up, and now we're melting away again, and I wouldn't be surprised if we break this low as long as oil remains under pressure because the oil stocks are just going to struggle up until we find that bottom that we're looking for. Last thing I'll talk tonight about, as this video gets a little bit longer than I'd like it to be, is the VIX. So, the VIX obviously was up today with the market down. But, on a day when the Dow was down 300 points and the S&P was down 1.83% or 37.5 points, I would have thought the VIX, even though we went all the way up to 21.29 today, I would have thought we'd be a little bit higher. So I did some calculations, and I think that we'll probably won't see much beyond, let's say, $22.5 to $23 in the VIX before we start another pullback. I don't foresee us taking out this high on this move. And what I mean about on this move is Wednesday is a short-term cycle pivot date. So that doesn't mean we're going to pivot Tuesday night and go up on Wednesday. It just means Wednesday's a pivot day, which is usually plus or minus 1 day. And that's a pivot for the stock market, the US dollar, the VIX, and what else did I have? I believe T-bonds, okay? So you have interest rates and or T-bonds. So you have the stock market, interest rates, T-bonds, the VIX, and the US dollar all pivoting plus or minus Wednesday, plus or minus a day Wednesday. So it could be tomorrow, could be as far as Thursday, but look for a market turn in this time frame, plus or minus a day Wednesday. I'm going to leave it there tonight. I appreciate everybody tuning in. Happy 2015. We're going to have a good year. Just stay tuned. Stay close. I'm going to lead you the way. This is David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.